Guys, so today I wanted to go over some of the most common investments that people make, and I wanted to rank them from S tier to a D tier investment, and we're going to be ranking them on viability, accessibility, returns, risk, and generally how good of an investment it is overall. So starting off strong with stocks. This is individual stocks, to be clear. We're not including ETFs here. ETFs and mutual funds we have as being separate, but stocks are going to be an easy A tier. Now, stocks are going to be a bit more risky. Individual stocks obviously have more risk associated due to being a singular industry. You run the risk of industry failure or something bad happening. Like, for example, say you have a lot of nuclear power, you're in the energy business, and then all of a sudden there's a nuclear leak, and now they got to shut down a lot of nuclear reactors. It hits the industry hard, and you lose a lot of money because you had a lot in, say, certain nuclear stock. So for that reason, stocks are going to be A tier. They're very solid return, but due to the fact that as individual picks, you do run the risk of not being diversified enough to avoid more industry specific risk, which is why it's only an A tier and not higher. And next up, we have ETFs or exchange traded funds. Basically, this is a fund that'll have multiple stocks inside of it, and it's fully automatic. No one really touches it. Minimal oversight. It's only really going to be managed by a few people that will set what's going to be in it according to what the ETF is. So, for example, if it's a Vanguard total market fund, someone will just come in and will say, hey, these are the specifications. We need you to capture every single stock there is listed, and we'll buy it in proportion to what it's worth. And you'll do like a weighing, and it will buy up that much of each of those stock. And no one manages it. Any change that happens, it's electronic. These are meant to be hands off, no one involved investing, and this is an easy S tier. Let me put this into S tier now. The reason that ETFs are an easy S tier is that they manage the most amount of risk with the best return. It's diversified. A lot of them are very, very easy to get into. A lot of them have extremely low fees. You're talking about less than like 0.5% on average for fees. You will make a lot of money with it holding ETFs in the long term. This is the bread and butter of retirement. This is your SPY fund. This is your NASDAQ. These tend to be the best possible investments out there for average everyday people. Therefore, this is an easy S tier. So up next we have hedge funds, and hedge funds are an easy S tier purely because there are some hedge funds that have beat the market, and certain hedge funds such as the Medallion Fund have completely crushed the market. So a lot of hedge funds do fail. I do think most hedge funds actually fail instead of succeed, but the reason that they're S tier is a good hedge fund that has the track record is one of the only few investments where you can expect to beat the market, and you will beat the market given that they, follow through with their previous track record. Of course, that's not guaranteed, but the assumption with a lot of these very successful hedge funds is that they're going to perform very well. And a lot of them do. Hedge funds like the Quantum Fund, the Medallion Fund, all of those hedge funds have outperformed. The only big issue with hedge funds is they're not accessible to most people. If you are just a regular dude, you don't actually have access to a hedge fund. You have to be someone who's called a sophisticated investor, meaning you have to have a certain amount of money to be able to take on the risk presented by hedge funds, because hedge funds have access to more tools that are not present to the public, and a lot of people who are invested in hedge funds are multimillionaires or multi-billionaires who have industry connection. So even if you do have the money for it, it's very rare to be able to get into a hedge fund, especially a hedge fund that's successful. Those ones tend to be almost impossible to get into. Like, for example, again, the Medallion Fund, it's one of those hedge funds that's currently closed off to the public. No one can get in unless you're someone who previously worked at the hedge fund, or you're a family member of someone who previously worked at the hedge fund. But because hedge funds do actually outperform, and if you put your money somehow into a hedge fund that is able to beat the market, you will get rich very, very easily. That's why it's an S tier, even though it's not available to probably like 99% of people. Next up, we have gold. Gold is going to be an A tier, an A tier. I was thinking S, but I think it's A tier. And I'll explain briefly what gold is and what gold isn't. So what gold is something that you can use as a hedge against inflation, meaning if the dollar goes down or your currency goes down, gold probably will more than likely historically maintain its value. Gold is also extremely stable. Gold very rarely, if ever, will lose value, and if it does lose value, it doesn't lose a lot of value. It tends to move very slowly up or down, which is to your benefit because gold is able to maintain its value very well. The main issues with gold is it's not a productive asset, meaning it doesn't produce anything. A stock will, potentially produce a dividend, or it'll be tied to a company that produces revenue. And then say, for example, like real estate will produce rent and other things, and a business will be able to produce revenues and products. Gold doesn't do any of that. That's why it's called a non-productive asset. And that kind of takes away from the value of gold a little bit because owning gold in and of itself doesn't give you anything, but it also means that you'll be able to maintain your value really well, which is why it's good to buy gold if you think that there's going to be a period of high inflation. And next up, we have mutual funds. Now, mutual funds, very similar to ETFs, are again funds that are a collection of stock, and you will invest $1 into the fund, and the fund will distribute your dollar across numerous different stocks, and that will make up the fund. So, for example, if you have a tech mutual fund, it may take your dollar and say, we're going to put 13 cents into Google, 12 cents into Microsoft, we're going to put 8 cents into Tesla, 9 cents into Amazon, and so forth. But the main issue with mutual funds is mutual funds are actually managed by people. It's an active management fund. The main risk with this is almost all mutual funds actually just perform as well as the market do, if not worse. I don't believe there was a single mutual fund other than Peter Lynch when he was working at Fidelity that actually outperformed the stock market. Every other mutual fund has actually failed at outperforming the market. So a mutual fund is kind of like a hedge fund that's available to everyone, but you don't get hedge fund like returns ever. It was only done by one person, and that person had retired years ago. Mutual funds also charge a lot higher of a fee than ETFs, and that fee actually will take away from your returns. That's why mutual funds are going to be a D tier because an ETF is always superior. You're going to get worse returns, pay more in fees instead when you can just pay significantly less in fees and actually get a higher return. This is why ETFs are still the king. Well, let me put it back up there. Get back up there. Hold up, hold up, hold up. There we go. That's why ETFs are still better than mutual funds, and that's why mutual fund is an easy D tier. They're not the worst investment you can make, but because there is such a superior alternative present right there, it makes it a D tier. It doesn't make any sense. It's one of the worst investments that people push to. Just buy an ETF and you'll be better off than without one. And then next up, we have commodities. Now, commodities, bit of a cop out. It's a massive category. This includes everything from technically gold and silver to oil. But I want to put commodities in B tier. The reason I'm putting commodities in B tier, it's for multiple reasons. One of the main reasons is it's not necessarily easy to own commodities. You either have to own a futures contract for those commodities, and those could be a little complicated to understand. And the other way that you could own a commodity is outright by buying it in a certain amount. Now, the reason that it's a B tier is if you know what you're buying and you buy a commodity like silver or gold and it's able to maintain its value and maybe grow relative to what the inflation rate is, commodities actually do turn out to be a good investment. But then there's certain commodities, say like soybean futures, where it's a lot more risky and you have to actually understand the market. It's more so catered to people who want to experiment more financially and take on more risk. It's not something for the everyday person. But that being said, there are opportunities that exist in commodities if and only if you really understand what you're doing. It opens up room for trading and it opens up room for maybe buying up, say, a lot of like a certain resource. And then in the future, maybe you know that this resource is going to be used for something and it spikes the value of that resource. That's when commodity investing would come in handy. But other than that, it's not something I recommend. But if you do understand what you're doing, commodities can definitely be not a bad investment. Next up, bonds. Bonds are going to be a B tier. What a bond is, it's a loan agreement. You loan someone money, they pay you an interest rate plus your loaned amount of money back. So, for example, the United States government gives out bonds. So, I'm the treasury. You'll give me $1,000, and let's say I'm going to give you $1,000 and 50 back at the end of 1 year. So I'll pay you out the 50 over time, and then I'm going to give you back your 1,000 at the end of the year. Now, bonds are actually extremely safe. They're considered to be a risk-free investment when they come from the US Treasury, and corporations issue bonds all the time. The main advantage to being a bondholder over a stockholder is in the time of a bankruptcy, the bondholder actually has a right to sue. The stockholder does not. The stockholder is actually not entitled to any sort of financial compensation, but as a bondholder, you are. That's the big difference. So if a company goes bankrupt and they're in the process of bankruptcy, they will be forced to pay out the value of bonds to their bondholders. They will not be forced to pay out the value of stock to their stockholders. This is why bonds typically have a lower rate because the risk is a lot less. But that being said, they are a safe way to get consistent income. If you have a lot of money and you pour, say, you saved up $1 million or $2 million, you pour that into a 4% treasury, you're making, $40 to $80,000 a year, effectively risk free. It's something you use to manage a portfolio. You do it to reduce your risk, and you do it so that way, if anything ever happens to the stock market, you have something that can back you up. And bonds rarely ever will fail. Now, some companies can go under and you can lose the value of your bond, but again, this is fairly rare. That's why bonds are a B tier, safe, solid investment, but they do offer lower returns. Next up, Bitcoin. Bitcoin's a C tier, and I'm going to explain why. My main gripe and issue with Bitcoin is it doesn't really do anything. Now, people will say, oh, it's a cryptocurrency. You just use it to buy stuff with. But are you seriously going to sell your Bitcoin for like pizza or something? I know that was a big story back in the day. But seriously, ask yourself, are you going to say, hey, I got, X amount of Bitcoins. I want to trade this for stuff. Or are you going to think, hey, I got all this Bitcoin. I can't wait to see what it's worth a year from now or 2 years from now. You're not going to trade it. You're going to want to make sure you hold it until you think the price of Bitcoin is more than what you're willing to sell for it. So, for example, if you think Bitcoin's worth 100,000 and it's at 120,000, you're comfortable selling. But if it's not there, you're never going to sell it. So, the whole idea of using it to exchange to buy stuff, it kind of falls apart because you're only ever going to really keep it if you think it's going to go up, and you would only really sell it if you think it's going to go down, and you're not going to want to sell it for a thing. You're going to want to sell it for money just so you could exchange it and capture your returns. That's really the main issue with Bitcoin. It's only worth what someone else is willing to pay for it. If no one is willing to pay anything for your Bitcoin, then your Bitcoin is worth basically zero. But that being said, the reason Bitcoin is C tier is because it's still Bitcoin. Um, you know, it's still something where I don't think the value is going to be lost, and maybe in the future it'll be worth more than what it is. But until then, I still see it as a C tier. It has to have more utility for it to be higher. And next up, real estate. Again, this is another easy A tier. Real estate is versatile. You can live in it, you can rent it out. It can produce rent, and on top of it producing rent, you could also have the real estate itself appreciate. So the unique thing about real estate is while you're using real estate, you can benefit from it appreciating, which is very different than a lot of other investments. You're basically buying a house, living in it, and making money in your home equity value going up. You're making, the mortgage difference. Say, for example, if you paid $300,000 your mortgage, but now your house is worth 500, you made $200,000 on paper in asset value. So that makes real estate really, really versatile and powerful also in a tax sense because real estate has really good tax laws too. If you know how to use the tax code to your favor with real estate, you can actually get away with paying a lot of taxes. Say, for example, there's certain like 1030 rules that you can do with real estate. I'm not 100% fully aware, but I do know that there are things out there where you can like 1031 or 1030 a home and you're able to avoid paying tax on the interest of the mortgage. Very interesting stuff. The main issue with real estate is it's not super available. A lot of these other investments, you could find ways to invest or, even buy a little bit of gold or buy maybe a little bit of stock, a few dollars of an ETF. With real estate, you have to buy something that is probably going to be six figures, if not more. Maybe even like low to mid six figures. So that really runs the risk of you being stuck in a 15 to 30-year contract where you really have to keep pouring money into the real estate and you don't want to risk losing it. Plus, on top of that, you do get hit with property taxes, and property taxes are a big negative to real estate. That being said, the benefits to real estate do outweigh the risk. You just have to be able to afford it. That's really the main barrier. Next up, other crypto. And other crypto straight D tier. All the main issues with Bitcoin, same thing with other crypto. The only difference is other crypto doesn't have the name brand recognition. There's some other stuff like Ethereum or XRP or Ripple or Bitcoin Cash where they have some name brand recognition. But even then, most of these cryptos, if they go up too high, people will immediately start dumping. A lot of them are rug pulls. A lot of it is a scam. I would avoid crypto the majority of the time. I don't think it's a good investment personally, and I don't recommend it unless you want to financially experiment and you don't mind losing the money you put into. There's a lot of rug pulls, a lot of scams going on. I would avoid anything that isn't Bitcoin, and if I wanted to buy crypto, I would buy maybe a little bit of Bitcoin if it dips down. Next up, options. Options, I'm conflicted. Options, I'm going to put a C tier and I'll explain why. So, an option is a contract where you think a stock is going to go up or down and you make a bet. And if the stock goes down, you're going to make significantly more than what you're going to make significantly more on the stock going down. And if this you bet that the stock's going to go up, if it goes up, say 1%, you might make 2, 3, 4, 5%. The main issue with options is they're risky. Options are incredibly risky. And if that risk is not well managed, which is very difficult for most people to do, you will lose money. That being said, options have a ton of utility. If you own, say, 10,000 Tesla shares and that's most of your net worth and you don't want to lose money when Tesla goes down, you can actually buy put options, bet against Tesla. So when it goes down, you maintain most of your worth when it comes to the value of Tesla. Because it goes down, your put options pay out. And if it doesn't go down, that's okay. You lose the put options, your value is stayed the same. So it's like a contract. It can be used for insurance and it can be used to make a bet if you think something is going to go up in a short period of time. The main issue with options is they're extremely complicated and the majority of people misuse options. They do it to gamble, they do it to make big, grandiose bets that don't go anywhere. It's not recommended again for 99% of people. Please stay away from options. Only reason it's not a D tier is because you can get good returns with them and you can use them to protect yourself and there's other strategies involving options that may be useful to some people, but it's not something I feel comfortable ever recommending anyone to do. And now, last but not least, we have a high yield savings account, and I'm gonna put this into B tier and I'm going to explain the main deal with the high yield savings account. So the way a high yield savings account works is that you'll put money in there and they'll pay you an interest rate for putting money in there. And usually this is offered by a bank. The bank will take the money that you deposit in there. They only need to keep a tenth because of fractional reserve banking. They'll take your money and they'll invest it in a bond. So if say a bond pays 5%, they may pay you 4.9 high yield savings. They'll put the money that you gave them into the bond at 5%. They'll pocket the 0.1% difference and you'll get 4.9. The main benefit to having a high yield savings to a bond is that a high yield savings account will pay out more frequently and you can access your money at all times. You don't have to wait for the bond term to be up. You don't have to wait until the end of the year to get your loan back. You can just withdraw your money at any time. So that's a big benefit to a high yield savings account. Granted, the return is less. It's not a great return. At best, you're going to get 4, maybe close to 5%. And there are better investments. Granted, it's also risk free because if it's FDIC insured, you can't lose money with the high yield savings account. If the bank goes under, the US government will step in to insure your deposit up to $250,000. And if the United States government is not available to insure your deposit, you have bigger problems to worry about than if your money in your bank account is safe. So I'm happy with this list, and I think I'm going to end it here. I appreciate everyone who tuned in. Please follow and stay tuned for more.